Hello, everyone, and welcome to Financial Accounting. Today, we continue studying planned assets and we'll discuss depreciation. If you haven't had a chance to watch the planned assets overview video, the link is in the upper right corner, and I will also post it in the description to this video. Before moving to depreciation methods, let's quickly review what depreciation is and go over terminology. Depreciation is a process of cost allocation. The cost of an asset is allocated to expense over asset's useful life in rational and systematic manner. The unused portion of asset's cost appears on the balance sheet. A portion of the cost is allocated to expense on the income statement each accounting period. Book value is calculated as the historical cost of the asset minus the accumulated depreciation. Book value is the undepreciated cost of the asset. Accumulated depreciation represents the depreciation taken on the asset since its purchase. Accumulated depreciation is a contra-asset account and is subtracted from the asset account to determine book value. Since it is a contra-asset account, it is increased by credit and decreased by debit. Assets are depreciated as we use them to help earn revenue. As assets are used, they incur physical deterioration and obsolescence. Depreciation is an expense account. It is increased by debit and decreased by credit. Now let's look at the common methods of calculating depreciation expense. Regardless of which depreciation method we decide to use to calculate depreciation expense, we need to know three variables: the asset's cost, the estimated residual value expected at the end of the useful life, and the estimated useful life of the asset. When we use the straight line method, depreciation expense is calculated as assets cost minus residual value divided by the number of years of useful life. Let's look how it works. On January 2nd, S&G Wholesale Grocery buys a new delivery truck. The truck costs $24,000, has an estimated residual value of $3,000, and an estimated useful life of 5 years. The calculation is easy: 24,000 less 3,000 divided by 5 years. The yearly depreciation expense is $4,200. Now let's review a schedule of the annual depreciation over the useful life of the asset. If you want to learn how to prepare depreciation schedule in Excel, follow the link posted in the upper right corner. I will also post the link in the description to this video. As you probably noticed by looking at the schedule, depreciation expense is the same in each of the 5 years. If this amount was plotted on a graph, it would be straight line. That is why the name of this depreciation method is straight line depreciation. Accumulated depreciation increases by $4,200 each year. We record it as a debit to depreciation expense and a credit to accumulated depreciation. Remember that expenses increase by debit and contra-asset accounts are increased by credit. Since accumulated depreciation is a real account and we don't close it at the end of the year, like we close revenues, expenses, and dividends, the balance increases every year by $4,200. You can learn more about real and temporary accounts by watching the video, The Accounting Cycle, Reporting Financial Results. I am posting the link right here and also in the description to this video. The cost of the asset less accumulated depreciation at the end of any year is called book value. Book value decreases by $4,200 each year. At the end of the asset's useful life, the book value is equal to the estimated residual value. This should be true regardless of the method used. So far, we looked at the depreciation of an asset purchased at the beginning of January. It doesn't happen very often that assets are purchased at the very beginning of the year. One way to determine depreciation for assets purchased during the year is to use the half-year convention. Using this convention, in the year of acquisition, we would record half a year or 6 months of depreciation. Let's see how it works. In this example, a company purchased equipment for $75,000 on some date in 2019. The equipment has a useful life of 10 years and an estimated residual value of $5,000. This company uses straight-line depreciation for all of its plant assets. Let's calculate depreciation expense for 2019 using the half-year convention. Using straight-line depreciation, the depreciation expense for an entire year is $7,000. This amount is determined by taking cost of $75,000 less residual value of $5,000 and dividing it by the useful life of 10 years. We need to divide the annual depreciation in half for the first year, since the half-year convention is used. The depreciation expense for 2019 would be $3,500. Now let's look at the declining balance method. There are a couple of good reasons to use this method for depreciation. One reason to consider the declining balance method is to better match depreciation expense with revenue generated. This idea is that a newer asset will generate more revenue in early years rather than later years, so the depreciation expense should be higher in the early years of ownership and less in later years. Another reason that the declining balance method is appealing to use for financial statements reporting, that it is similar to the depreciation method used for tax purposes. Calculating depreciation expense under the double declining balance method is a three-step process. First, we calculate the straight-line depreciation rate. Do this by dividing 100% by the asset's useful life. The second step is to calculate the double declining balance rate, which is done by multiplying the straight-line rate times 2. The final step is to determine depreciation expense. Multiply the double declining rate times the book value of the asset at the beginning of the period. Note that under the double declining balance method, estimated residual value is ignored. Let's take a closer look at how it's done. On January 2nd, S&G Wholesale Grocery purchased a truck for $24,000. The estimated useful life is 5 years, and the estimated residual value is $3,000. Let's calculate the amount of annual depreciation using the double declining balance method. The first step is to calculate the straight-line depreciation rate. Remember, this is done by dividing 100% by the asset's useful life. In this case, divide 100% by the 5 years useful life to get a straight-line rate of 20%. The second step is to calculate the double declining balance rate. Do this by multiplying the straight-line rate times 2. In our case, it is 20% times 2 equal to 40%. The final step is to determine a depreciation expense. Multiply the double declining rate times the book value of the asset at the beginning of the period. In this case, multiply the beginning book value, cost less accumulated depreciation of $24,000 by 40%. Keep in mind that we ignore the estimated salvage value when calculating the depreciation expense under the double declining balance method. While book value should always be equal to the estimated salvage value at the end of the asset's useful life, It just will not work properly using the double declining balance method. In our example, the book value at the end of the 5th year needs to be equal to 3,000, the estimated residual value. The only way that can work is to force depreciation expense in the last year to be the amount needed to bring book value down to residual value. Remember that depreciation is just an estimate. It doesn't have to be perfect. At the end of the 5th year, depreciation expense will be recorded at $110. This amount is determined by subtracting the salvage value of 3,000 from the book value at the end of the 4th year, which is $3,110. Notice that no matter which depreciation method is used, the total depreciation taken at the end of an asset's life will be the same. In this case, for both the straight line method and the double declining balance method, the total depreciation taken is $21,000. Auditors review management's estimates for useful lives and residual values for reasonableness. Remember about the principle of consistency. You cannot switch depreciation methods from period to period unless there is a compelling reason for the change. You know that salvage value and the useful life of a planned asset are both estimates. Like all estimates, new information may come to light and will warrant a revision of a previous estimate. Let's see how accountants handle the revision of previous estimates. In this example, a company purchased equipment on January 1st, 2016 for $30,000. The equipment is estimated to have a 10-year useful life and no salvage value at the end of its useful life. The company uses the straight line method for all planned assets and begins recording depreciation on this equipment in the year of purchase. The original computations for the first 3 years are continued. During the 4th year, new information is learned about the equipment that caused a revision of the estimate of the equipment's useful life. The equipment is now believed to have a total useful life of 8 years. Depreciation expense for 3 years has already been recorded, so there are 5 years remaining in the equipment's useful life. We take the book value at the end of revision of the estimate and subtract any estimated salvage value at the time of revision. This total is to be divided by the remaining useful life of the asset at the end of revision. Let's calculate the proper depreciation expense after the revision is done. The asset had a cost of $30,000 and 10-year useful life with no salvage value. Under straight line depreciation, $3,000 of expense is recorded in the first 3 years. Let's calculate the depreciation expense at the end of 4th year. The original cost of the asset was $30,000. Accumulated depreciation has a balance of $9,000 at the beginning of 4th year. The remaining book value is $21,000 and the remaining useful life of the asset is 5 years. So depreciation for each of these 5 years will be $4,200. What do we need to do if an asset loses its value? If the asset's value decreases and cannot be recovered through future use or sale, the asset is considered to be impaired and should be written down to its net realizable value. That's all for today. Thanks for watching this video and I hope you found it helpful. Don't forget to like and subscribe. And as usual, more videos are coming soon. I will see you next week.